In the aftermath of the 1987 stock market crash, Wall Street was gripped by fear, uncertainty, and a frantic scramble for short-term safety. Yet, in the quiet confines of Omaha, Nebraska, Warren Buffett was orchestrating a move that would redefine modern finance. Between 1988 and 1989, Berkshire Hathaway quietly accumulated over $1 billion in Coca-Cola stock. At the time, this represented a massive concentration of capital, roughly a quarter of Berkshire's entire equity portfolio. To the casual observer, buying into a seemingly mature beverage company in a volatile market looked like a defensive, perhaps even uninspired play. But unpacking this decision reveals something entirely different. This was not merely the purchase of a popular drink. It was a strategic masterclass in intelligent investing, a deliberate acquisition of an unparalleled economic moat, and a blueprint for creating enduring generational wealth. To understand why this investment is a masterpiece, we must first look at the landscape of the late 1980s. Coca-Cola was emerging from the infamous New Coke debacle of 1985. While the company had quickly pivoted back to its original formula, restoring consumer trust, the financial markets were still pricing the stock as just another large-cap consumer goods company. Analysts were fixated on quarterly earnings, fluctuating sugar prices, and short-term currency headwinds. Warren Buffett, however, did not invest based on the next quarter. He trained his sights on the next quarter century. He was able to see value where others saw only temporary stagnation. He recognized that the market was fundamentally mispricing the most powerful brand on the planet. When we analyze this through the lens of true financial sovereignty, we see that enduring freedom is not achieved by chasing trends or timing market corrections. It is built by acquiring assets that possess an inherent, almost unassailable advantage over their competitors. For Berkshire Hathaway, Coca-Cola was the ultimate embodiment of this principle. Buffett understood that human habits are deeply ingrained, and the act of drinking a Coca-Cola was tied to happiness, nostalgia, and daily routine across the globe. This was not a commodity. It was a psychological monopoly. This brings us to the core concept that made the Coca-Cola investment a strategic masterclass: the economic moat. In medieval times, a moat protected a castle from invaders. In business, an economic moat protects a company's profits from competitors. Buffett identified that Coca-Cola possessed a moat so wide and so deep that no amount of rival capital could effectively breach it. First, consider the brand power. A brand is not merely a logo or a catchy slogan. It is a promise of consistency and a reservoir of consumer goodwill. Coca-Cola had spent a century embedding itself into the global consciousness. You could give a competitor billions of dollars and task them with displacing Coca-Cola in the minds of consumers, and they would fail. This level of brand equity provides pricing power, which is the ultimate defense against inflation and economic contraction. When the cost of raw materials rises, a company with a strong economic moat can pass those costs onto the consumer without losing market share. Consumers will readily pay a few cents more for the authentic Coca-Cola experience rather than switch to a generic alternative. This pricing power ensures that profit margins remain robust, protecting the underlying value of the asset. Second, we must examine the distribution network. Coca-Cola's infrastructure was and remains a marvel of global logistics. The company had spent decades building relationships with bottlers, distributors, and retailers in nearly every country on Earth. Whether you are in a bustling metropolis or a remote village, a Coca-Cola is always within arm's reach. This ubiquitous availability creates an insurmountable barrier to entry for new competitors. To replicate that distribution network would require infinite time and incalculable capital. For an investor focused on asset protection and long-term stability, this infrastructure represents an impenetrable fortress. But the strategic genius of this investment extends beyond the brand and the distribution. It lies in the fundamental architecture of the business model itself. Many people mistakenly believe that Coca-Cola is primarily a manufacturing company, churning out billions of bottles of liquid. The reality is far more elegant and capital efficient. Historically, Coca-Cola's core business has been producing the proprietary syrup, the concentrate, and selling it to a vast network of independent or semi-independent bottlers. This distinction is crucial for anyone studying strategic entrepreneurial ventures. Manufacturing and bottling are highly capital-intensive. They require massive factories, fleets of trucks, and immense overhead. By focusing on the high-margin concentrate, Coca-Cola outsourced the most capital-intensive aspects of the business while retaining absolute control over the intellectual property and the brand. This resulted in staggering returns on invested capital. The company could grow its global footprint exponentially without requiring massive infusions of cash to build new infrastructure. Think of this in the context of real estate acquisition. A highly capital-efficient business operates much like a prime piece of commercial real estate in a world-class city, but without the constant need for expensive maintenance, roof repairs, or physical renovations. Once the asset is acquired, it generates a relentless, growing stream of cash flow. For Berkshire Hathaway, Coca-Cola was the ultimate cash-generating property. The capital required to maintain the company's growth was minimal compared to the cash it produced, allowing those immense profits to be returned to shareholders or reinvested into further global expansion. Let us delve deeper into the consumer psychology that Warren Buffett understood so perfectly. Coca-Cola did not just sell a beverage, it sold a standardized, predictable experience of joy. Whether you opened a bottle in Tokyo, London, or New York, the taste, the effervescence, and the emotional resonance were identical. In a rapidly globalizing world, this consistency was invaluable. Buffett recognized that as the middle class expanded in emerging markets across Asia, Latin America, and Eastern Europe, the consumption of Coca-Cola would rise proportionally. He was not just betting on American consumption, he was positioning Berkshire Hathaway to capture the economic upside of global human development. This foresight into international expansion highlights a critical component of strategic investing: scalability. An asset that can only thrive in a localized market has a natural ceiling. An asset that can scale globally without fundamentally altering its core product has virtually unlimited upside. Coca-Cola's syrup model allowed it to scale across borders with incredible speed. They simply partnered with local bottlers who understood the regional terrain, effectively leveraging local capital to expand their global empire. This is a masterclass in utilizing strategic partnerships to accelerate growth while minimizing risk and capital expenditure. Identifying a great business, however, is only half the equation. The other half, and arguably the more difficult part, is the discipline of long-term investing. The true power of Warren Buffett's Coca-Cola masterpiece lies in his unwavering commitment to hold the asset through decades of market turbulence, economic recessions, geopolitical conflicts, and shifting consumer trends. Since that initial purchase in the late 1980s, Berkshire Hathaway has not sold a single share of its core Coca-Cola position. This level of inaction is profound. In a financial ecosystem that rewards hyperactive trading, complex derivatives, and constant portfolio turnover, Buffett's strategy of absolute stillness stands as a radical act of wealth preservation. Every time a stock is sold, taxes are triggered and capital is bled away. By holding the asset indefinitely, the capital is allowed to compound uninterrupted. This uninterrupted compounding is the absolute bedrock of generational wealth. Let us look at the mechanics of how this plays out. When Berkshire Hathaway completed its initial purchases, the total cost basis was roughly $1.3 billion. Today, that stake is worth tens of billions of dollars. But the capital appreciation is only part of the story. The true magic lies in the dividends. Because Coca-Cola is a highly profitable, capital-efficient business with immense pricing power, it generates far more cash than it needs to operate. It returns this excess cash to shareholders in the form of dividends. When Berkshire first bought the stock, the annual dividend check was significant, but relatively modest compared to the overall portfolio. However, because Coca-Cola has consistently raised its dividend year after year, decade after decade, the cash flow generated by this single investment has become a torrential river of capital. Today, Berkshire Hathaway receives hundreds of millions of dollars in cash dividends from Coca-Cola every single year, without ever having to sell a single share. The annual dividend payout now represents a massive percentage of the original purchase price. This means the investment essentially pays for itself repeatedly, year after year, in pure cash. Furthermore, we must examine this investment through the lens of asset protection. In the pursuit of financial freedom, protecting what you have built is just as critical as the initial accumulation. Wealth can be eroded by taxes, inflation, poor management, and technological disruption. How did the Coca-Cola investment protect Berkshire Hathaway's capital? First, it provided a fortress against technological disruption. The technology sector is littered with the corpses of once dominant companies that were rendered obsolete by a faster, cheaper, or more innovative competitor. But the human desire for a cold, refreshing beverage is not subject to technological obsolescence. Software changes, hardware degrades, but fundamental human tastes remain remarkably stable over centuries. By anchoring a significant portion of his portfolio in a business immune to rapid technological decay, Buffett insulated his wealth from the most unpredictable forces in the market. Second, it provided an impenetrable hedge against inflation. We have touched on pricing power, but its role in asset protection cannot be overstated. Inflation is a silent tax that silently confiscates purchasing power. If you hold cash, you are guaranteed to lose wealth over time. If you hold businesses with low profit margins and heavy capital requirements, inflation will crush their profitability as their costs rise faster than they can raise prices. But a business like Coca-Cola, with its massive gross margins and unshakable brand loyalty, simply adjusts its prices upward. The nominal profits rise alongside inflation, protecting the real purchasing power of the investor's capital. This is why acquiring businesses with deep economic moats is the ultimate form of asset protection. It is also essential to contrast Buffett's methodology with the prevailing culture of Wall Street. The financial industry is largely built on the generation of fees. Brokers, advisors, and fund managers make money through activity by constantly buying, selling, rebalancing, and restructuring portfolios. This activity creates friction, taxes, and immense drag on long-term performance. The Coca-Cola masterpiece stands in direct opposition to this culture of perpetual motion. It requires a profound level of emotional intelligence and psychological fortitude to sit still for over 3 decades. When the dot-com bubble was inflating in the late 1990s and technology stocks were minting overnight millionaires, Buffett was heavily criticized for being out of touch, for holding on to an old economy stock like Coca-Cola. He ignored the noise. When the bubble burst, decimating those high-flying portfolios, the enduring value of his strategy was vindicated. This psychological discipline is the most difficult aspect of intelligent investing to master. It is easy to identify a great company in hindsight. It is incredibly difficult to buy it when the market is fearful, hold it when the market is euphoric about something else, and maintain absolute conviction in the underlying business fundamentals regardless of the stock price's daily fluctuations. To build generational wealth, you must cultivate this exact brand of strategic patience. You must transition your mindset from that of a speculator, hoping to profit from the erratic movements of a stock chart, to that of a business owner, seeking to acquire streams of free cash flow. Unpacking the Coca-Cola investment reveals a blueprint that transcends the stock market. It applies directly to real estate acquisition. When you buy a multifamily property in a prime location, you are looking for a moat. Perhaps it is proximity to major employers, highly rated schools, or constrained housing supply. You are looking for pricing power, the ability to raise rents over time to combat inflation. And you are looking for long-term cash flow that can be reinvested into further acquisitions. It applies directly to your own strategic entrepreneurial ventures. When you build a business, are you building a commodity that competes solely on price? Or are you building a brand that commands loyalty? Are you creating a capital-intensive nightmare or a scalable cash-generating machine? Warren Buffett did not just buy shares in a beverage company. He acquired a globally scalable, inflation-resistant, cash-producing monopoly of the human mind. He wrapped his capital in an impenetrable economic moat and let the relentless mathematics of compounding do the heavy lifting over decades. This is why it remains a strategic masterpiece. For those committed to the journey of unshackling their capital, the directive is clear. Seek out the moats, demand pricing power, prioritize businesses and assets that require little capital to maintain but generate massive cash flow. Once you have acquired these rare assets, protect them fiercely. Ignore the frantic noise of the daily markets, the allure of quick riches, and the pressure to constantly act. Anchor your capital in enduring value. Exercise the profound discipline of long-term investing and build an unshakable foundation of generational wealth that will stand the test of time.